All right, team. Have you seen the documentary on Netflix, "Who Killed the Electric Car"? I almost titled this video "Who Killed Mortgage." I was going to say "Who Murdered Mortgage Rates," but I thought they might. I thought they might censor my video because of the language. So we have a slap happy kind of fun day today, where you try to figure out what do you do next to try to explain what's going on here. And ultimately, if you've been watching the videos, you subscribe to the channel, you're not surprised by this at all. We've been talking about the cascading effect in mortgage bonds, which has been going on for quite some time. And, what does that mean exactly? Like, what do you mean cascading? Basically, we mean momentum building. Momentum building in the wrong direction, unfortunately. So I'll zoom in here. This is a zoom out of mortgage bonds. Remember, when these prices go down, that means that the yield associated with those prices goes up. So mortgage rates go up when these bond prices go down and vice versa. So we want to see mortgage rates go up. When we saw mortgage rates up here a year ago, that was great. And this was, when was this? September of the previous year. That was great. The ultimate double top, though, here got us. And, big sell-off here, mortgage rates spike. Big run up here, mortgage rates drop. You get it. That's how it works. So now let's zoom in. Why is this happening? What is going on? Well, you have to go back here to COVID. These crazy candles here are COVID. I remember I told my wife the same thing when we were going through that I told her today, which was that, the business is in trouble. The mortgage business is in trouble because essentially refis are going to go away. We have just the purchase business. And even back then we had low inventory situation, but back then was a lot more uncertainty even on purchases. Now we know there's plenty of people who want to buy homes, but there's so few homes to buy. It's tough to just run a purchase pipeline. And refis are probably going to go away for the most part. Rates still haven't gone up that much yet. The problem is there's no end in sight for this, and I'm going to explain why. So when this happened, this was the market reaction to a, let's call it natural event, COVID, right? We had an event that was going to cause problems to the economy. The reason we rebounded so quickly was because government stimulus. The government came in, saved the day. It said, hey, you know what? We're going to come in, we're going to buy more bonds, we're going to loosen monetary policy, we're going to make sure there's plenty of liquidity. Essentially, they just dumped a ton of money into the system. A ton. Those of you who saw my national TV interview, you heard me say, this is a fact, 25% of all of the dollars in existence, 25% of all of them were printed in the last 12 months. And so that doesn't even go back to COVID. That goes back not even that far. It's just insane how much money they've dumped in the system. The Fed on Monday basically said, and what's interesting was I went and I did a search here on CNBC for Jerome Powell, and there was hardly anything. And the Fed is like, where are all these articles? I've seen the articles come up. Where are they? What you'll see here is a lot of people on Wednesday are saying, hey, what to watch at Wall Street looks steady after Wednesday's major Fed-driven sell-off. So they're just blaming the Fed. Global markets slump on hawkish Fed minutes. Well, the Fed did this. They put the stimulus in because they believed that we were in a massive deflationary spiral potentially, and they wanted to make sure that the economy didn't go into a major crash. That's their justification. Now, the reason we're selling off, and you can see we're actually close to where we were. So this is where we were at this level here when the COVID madness began, and look at where we are today. Today, we're right here. So we're much worse off now. And they're removing the stimulus. That's my concern. We're easily 100 to almost 200. We're about 200 basis points lower now than we were before that stimulus began. And the rug pull has began. So what I mean by that is the Fed has accelerated their timeline twice now. Let's zoom in a little bit more here. At first they said, hey, I remember this. What is this, like 6 months ago? Jerome Powell came out and said, hey, we're not going to do anything. We're not touching anything. We need a lot more data before we do anything. Then he came out and said, okay, yeah, we need to ease. We need to pull this back in. And that's when they're going to start curtailing some of the purchases that they're making. Because keep in mind right now, the Federal Reserve is actually buying bonds as if they were an investor to try to prop the market up. Well, they're going to start tapering those purchases back. They made that announcement. Then they made the announcement that they were going to actually do it sooner than they had thought they would. Then they made the announcement that they were going to do it more aggressively than they thought they would. And then they just came out this week, although they had this discussion weeks ago, they released the minutes this week saying, actually, we're going to do this right away. Basically right away. So the taper has began a little bit in November, a little bit in December, but now it's being accelerated. The market is now well aware of this, and you can see it's just selling off like crazy. And as I've said on this channel for months, who would buy a bond? Who would buy a bond except the government trying to prop the market up, because it's a terrible investment. It's terrible. 2.5%. The Fed is telling us we're at 6% inflation. So buying the bond means you're losing 3.5%, 4%. Who wants a guaranteed loss? It's silly. With risk, by the way, with risk. These assets are not without risk. And by the way, you only get the 2.5% if you buy it at a coupon rate of 100. If you buy it above 100, then that yield goes down. So again, we need these bond prices to get to here for investors to even they need to get down to this 100 mark here before the investor actually gets 2.5%. So it's a terrible investment. And so far this week, let's zoom in further. It's been bad. Now in 2021, we lost about 400 basis points on this bond chart from top to bottom. So far, here in 2022, we started right here, just under 102. Now we're just over 150. So let's call it 150 basis points. Is that right? No, less than that. Let's call it, I don't have exacts here, but let's call it 125 basis points. Okay, it's probably 130, something like that. We lost 130 in the first week. We only had one day where the buyers looked like they were stepping in right here, and you could see the bullish hammer that was formed. It was a very light volume day, though. It was the smallest candle we've had so far this week. Actually, no, I guess yesterday was a relatively small candle as well, but it's all just been red. All just been red. So we've gone from there to here. So here's the cascading effect. Here was the first trend line up here. You see that one. And then it got worse. And now it's like this. And really, I should almost draw another one that's even more straight down. So the slope keeps increasing. This is why you hear urgency in my voice. This is why I made the post earlier today. This is why I sent out the message to, all my realtor partners. I believe it was Monday or Tuesday that, hey, rates are going to go up. Be prepared. Talk to people about it. Have the conversation. Understand what's going to happen. Now, the big question is, will this impact real estate values? And as I've mentioned before, I don't think that it will. Only risk is if it happens too fast. If we see rates go up 1% in 2 weeks, like if we have another week like this next week, we're starting to get there. If we have this 3 weeks in a row, yeah, it is going to impact real estate. You can't have rates go up that fast because we could lose half of the buyers that we have in the pool, and we could gain twice the inventory, 3 times the inventory that we have right now. It would still be a seller's market. So the real estate market has a lot of room to move for the pendulum to swing back towards buyers before it's a level playing field. Long ways to go. This helps. It does. But it's painful. Particularly, it sort of kills refis. Not all of them, but kills a lot of them. A lot of the EARLs, the people who had like 2.75 going for 2.25, that's dead now. The people who had like 3.5 conventional trying to go to 3 or drop PMI or whatever, that may be dead now. Some people are paying enough in PMI that it makes sense to refi even if you get the same rate because the PMI is not tax deductible. If you have questions about refinancing, I won't go into it too much. Just give me a shout. You can call, text, email me whenever. Let's see what Jed has to say here. And we're live, so you can throw comments in if you want. Mortgage rates will not rise significantly with No reaction in the real estate markets. Let me unpack your double negative here, Jed. Mortgage rates will not rise with no reaction in the real estate markets. I think what he's trying to say is that if rates go up, that you will see a reaction in the real estate market. You will. The question is, will it impact prices? Or will it just, will prices go down, or will acceleration slow down? So my belief is that if rates don't spike quickly, we're going to see 10 to 15% this year in appreciation. If rates do spike quickly, maybe we see more like 5 to 10, something like that. But I think there is too little inventory and too much demand. Look at how many transactions are taking place in cash. It's over a third of transactions nationwide are in cash. So interest rates don't matter that much. Real estate, what's going on right now, you look at cryptocurrencies are getting hit pretty hard across the board. You can always look at, if you go to CoinMarketCap and you just want to kind of take the temperature of it, you can look at the total market cap of the cryptocurrency market right here. And that'll give you a feel of how much money is in the entire thing. And it's under 2 trillion now. It was over 2 trillion for quite some time. Of course, $1 trillion of that, or most of the 800 billion of that, is in Bitcoin. So Bitcoin is the big, the 800-pound gorilla, and Ethereum is about half that as the second one, and then it drops off a lot from there. A couple things to keep an eye on, though, when we look at crypto. And I'm going to talk about the relationship between crypto and stocks and real estate, and how that all is sort of running together. Because what happens is, the reason why stocks have run so much is because there's been, you can't earn interest anywhere. And I made a video earlier this week about how you can make 8% on Gemini US dollar, which is a stable coin. And if you look at the stable coins today, you'll see, what is Tether? Number 3 crypto, $1. Where's the next one? USD coin. What's that trading for today? $1. That's what stable coins do. That's what they are. There's probably one in here that's like, here's Terra, 0.9989 cents. So that's what stable coins do. They will be at $1. And the Gemini US dollar, they actually, on Gemini, here's DAI as well, 0.99999. Gemini, if you get your Gemini US dollar from Gemini directly, it's always 1-to-1 even. And they guarantee that for you on their website. So if you do it there, you're fine. You get 8% interest. The reason why I brought that up is because I believe the stock market is going to take a dive. I believe, and I've seen this many times, that, okay, do we all know that the stock market is manipulated by Wall Street, by government officials? I don't want to be like the guy who's telling you there's no Santa Claus, but can you take my word for that? When we see lots of all-time highs happening with not a lot of movement in the actual price, like they're just barely eking out all-time highs so they can get the headline, that is usually when the big boys are selling to the little guys. And I believe, and we also know that the price of cryptocurrency is largely influenced by Bitcoin, which makes it easy to manipulate the entire market if you can manipulate the price of Bitcoin. If you haven't read this book, let me do a book recommendation here. It's called, and this was back when I don't know much about Jim Cramer these days. Really don't. I don't watch his show much, but some of the stuff I've seen has been suspect. But this book is a must read. He wrote it right after he left Wall Street. And this is like the #1 hedge fund guy of all time. He averaged 24% annual compounding returns for his clients. Confessions of a Street Addict, a Wall Street addict, not a drug addict, a Wall Street addict. Talks about how he woke up at 3 a.m., all the things he would do trading in Hong Kong, doing this and that to get ahead. And he specifically explains in this book how they manipulate markets. And it usually begins with, look, it shows when I purchased it 2013. That's funny. It begins with knowing which single stock, or in this case, single coin, is the one that drives the behavior. Like at the NASDAQ right now, it would be Tesla, for example. Which stock is the market keying off of? Because if you can knock that stock down, you can knock the whole thing down. And I think we're seeing that happen right now with Bitcoin. This is just my opinion. I think we're seeing that happen right now with Bitcoin. The cryptocurrency market's being knocked down. I think Wall Street wants to rotate out of stocks and into crypto. I know it sounds crazy, but I know people that I trust on the inside of some of these things. They're telling me that Wall Street is coming for your crypto this year. And right now the S&P is at like a 45 PE, price to earnings, last I checked. Typically, we see corrections happen long before we get to 40. Oh, they're not going to show it over here. I don't have the PE. Okay. I'll have to show it to you in a different way. But, the PE is almost 50. Usually corrections, crashes happen before you get to 40. We're at 50. So the valuation of the stock market is way overdone. So with the Fed now tightening monetary policy, we can totally expect stocks to sell off. That's absolutely what should happen. The reason they've been running is because of the cheap money. Also, inflation is a great mirage for growth. For example, if you have a company that is, let's say they did 20% more revenue this year than last year, but it's mostly because of rising prices. They're able to raise prices, which is inflation. It looks good, makes you think their growth, that they're hitting their targets, that it's worth investing in, but really it's just inflation. It's just rising prices. They didn't really do anything to improve their business, but they brought in more money, but the money's worth less. So, it's inflation can be a mirage for growth. It's the perfect mirage for growth. And so that has me concerned about overvaluations in the stock market as well. I think a stock market correction is going to happen this year. My guess is that, it would happen sooner rather than later. But if the Fed is going to be fully exited from, and I read that and I can't find the article. I guess I have to start saving these articles. They're pulling some of these articles down. If they are going to exit their positions, and that's clean the balance sheet by the end of first quarter, then that is a major rug pull, team, a major rug pull. So overall, where will the money go? What will happen? Well, it's definitely coming out of bonds, because by virtue, and this is the double-edged sword, and the reason why I think rates are going to have more upward pressure. By virtue of admitting that they need to tighten the policy, by virtue of by the Fed saying we need to do this more quickly, it's the same thing as them admitting that inflation is much worse than they've told us. So they've admitted it. And inflation is really bad for bonds. Now, not only have they admitted that inflation is really bad, it's so bad that they have to get out. This would be like if you were in the ocean, stranded, your boat crashed, and someone comes to save you in a helicopter, and they drop down into their little speedboat, but the waters are so bad, they have to save themselves, and they have to leave you there. They have to say, you know what? Your safety raft has to go because the waters are too dangerous. That's what's happening. They are saying what we have created here with our policy is so bad that we have to stop it now. We have to get out, and we're gonna slowly close the door. But then every time we hear from them, they're closing the door faster. So this is the reason why you're seeing such an accelerated move downward in bonds. And if you have a loan that gets in a contract, by golly, the loan officers who watch this, lock your loans ASAP. I know I've been saying that for weeks. Lock your loans ASAP. If you want to refi, do it now or forever, hold your peace. Whatever they say in weddings, I can't remember. It's not going to get better. There's no catalyst for it to get better. The catalyst for it to get better was announced. And unfortunately, the catalyst for it to get better, which is the Fed tightening policy, is also, unfortunately, evidence that things are much worse in the other direction. And so it's working against us. And I don't have any good news on that front. I really don't. But I will say this. Be smart with your money, okay? Be smart. Look at your investments. Make sure you know how you have your portfolio allocated between your real estate, between your cryptocurrencies, between your investments in stocks. It makes no sense to own bonds in this inflationary environment until we get more information about the inflation. It makes no sense to own bonds. None. And does it make sense to have money in cash? Maybe. Maybe not. Not with inflation, certainly not long term. And that's the reason why I brought up the Gemini US dollar, and I made that video, and I showed you that video recently. I want you to know there is a place you can earn yield 1 for 1 on your dollar. That's where I'm headed. But I do think we will see a lot of money, especially over the next 10 years. You're going to see a lot of money that would normally have gone into retirement accounts and 401ks and stock market. A lot of that money is going to get invested in the cryptocurrency market. And I promise you, watch this video 5 years from now, and we talk about a market cap in crypto of 2 trillion. Everyone will laugh. It'll be 10 trillion, 20 trillion. It's going to be way, way bigger. And so, that transition, the passing down of that wealth from the baby boomers to the Gen X, Y, and Zers or whatever, that is going to take some time. But what you're going to see is that with stocks, and this is the big thing, and this is the main reason that I believe this is the case, stocks have been the place to get returns, right? If that stops, what do you turn to? If you know that the stock market is overvalued, you know it's overvalued because we have metrics. We have metrics that are used to determine the value of companies, price to earnings ratio, for example. We have things we can look at like that. In the cryptocurrency world, you don't really have that. You don't really have it, which is why a lot of people are afraid of it. Hey, I don't have no idea how can I tell what a Bitcoin should be worth? What's the book value? There's no such thing. It doesn't exist. So there's no way to really tell if one of these tokens is overvalued or not. You can have people who are looking at charts. You have people who are doing technical analysis and doing all sorts of stuff like that. But you don't really have a way to say, you know what, Bitcoin is really undervalued at 42,000. There's no way to know that. So I think what you will see is a lot of the younger generation who is in stocks, who've been buying stocks, who've been trading Tesla, GameStop, and stuff like that. When the overall market takes a dive, I think you're going to see that money ultimately flow into crypto because there will be gains over here. There will be things happening. Look, biggest gainers today. Look at this. Metacraft up 3,200%. Escrowed Illivium up 600%. Dragon Infinity up 600%. You're always going to see crazy stuff like this happening in crypto. You're always going to see it. And so if you're over here getting beat up in stocks, you move your money to cash that makes you feel safe for a minute, but then you realize, man, I got to put my money to work. What are you going to do? Are you going to buy baskets of these little baby cryptos? Maybe. What you really should do, the safest investment, the best investment is still going to be real estate. It is. And when I say the best, I want to be clear about what I mean by that, because I'm not a financial advisor. This is not financial advice, of course. Real estate is the best investment because you get so many different things with less risk, right? You have appreciation, which you can get a huge amount tax-free if it's your primary residence. You have depreciation if it's an investment property and write off every single expense you have. You can live in it. You can live in it. You got to live somewhere. You can't live in a coin. What did my buddy tell me one time? I was telling him about Bitcoin, and he said, you can't live in a Bitcoin. It's like, you're right, man. You're right. There are higher risks with cryptocurrencies. There are higher return possibilities. But real estate is the best investment because it has a floor. Listen, Bitcoin can go to $0. Any house out here, none of these houses will ever go to $0. Even if you burn the freaking house down, the ground it sits on is worth hundreds of thousands. So even if you burn the house down and you didn't pay your insurance policy, it ain't going to zero. That is why, for almost everyone, real estate is the best investment. It is. It's the best investment. Overall, when you calculate everything, risk to reward, worst case scenarios, with cryptos, yeah, if you pick the right ones, maybe you do really well. With real estate, listen, throw a dart at any one of these green guys, any one of these. And 10 years from now, look at what it's worth. I mean, if we could rewind the clock on Redfin, that'd be pretty cool, right? If you could rewind the clock and see how much these houses went for. What's $499? What is that going on here? So any one of these, pick them, and then look at it 10 years from now, 20 years from now. They're all going to be up. That's not going to be the case with crypto. That's not going to be the case with stocks. It will be the case with real estate. That's why it's the best. So if you've got your fill of real estate, if you're good, you bought a house or you have a few or whatever, and you're good on that, you're looking for other things, then maybe something else. There's a huge generation right now of people who don't own real estate, who are trading stocks, and I think those people will go to crypto. So bottom line, long story short, buy this book, Confessions of a Street Addict, if you want to learn how markets are manipulated by Wall Street, by big money funds, international money funds, the richest of the rich. He explains it in great detail. He did it himself. It's direct from the horse's mouth. It's eyewitness testimony direct from someone who did it. And by the way, it's all legal, 100% legal what they're doing. Unethical, but legal. Notice how there's a lot of things that are unethical but legal. A lot of things like insider trading, Congress, etc. So they can manipulate markets. Buy that book, understand that. Know that mortgage rates are going to get worse. Just know that. There's no reason to have a candlelight vigil, no reason to say any prayers. This is what's happening. Pray for someone else. Pray for something else. This is happening. I'll keep you posted on how bad it's going to be. And when I think we may have finally found the new norm. Could be a while. Could be a while. I hope it's tomorrow. My goodness. I just want to see one green candle. Can I get one green candle? Maybe. Wore my green shirt today. What's up, Brandy? You turn to real estate when stocks go down. You know what? You turn to real estate anytime. Anytime, all the time. Anytime, all the time. You can't go wrong. If you have a long-term outlook with real estate, that's what I always say about real estate. You don't have to be a genius. You don't have to study EBITDA and know which company CEOs is legit and which one's a phony, or which coin is going to work in some higher level system and ultimately blow up. You don't have to know any of that. You don't have to be a genius. All you have to do is have the stones to pull the trigger. That's it. Stones to pull the trigger, and then the time frame. I know lots of people who have done extremely well with real estate in the last few years. Barely had two nickels to rub together when they bought their place. Now they have hundreds of thousands of dollars in equity. Not geniuses. Don't need to be a genius. Just have to have the stones. Rental prices are crazy. Yes, and rents are going to go up. You can count on that. I know I've been talking about that a ton. But rental, a lot of landlords don't realize how far under renting their properties they are. But they are learning. And I'm getting calls from people every day. Hey, my landlord says my rent's going up $500 a month. So I'm going to look at buying. They're learning, they're figuring it out, and they're letting people know every day. So the king of everything is real estate. Now, for some people, you buy your house, you're like, okay, I'm good with that. I bought $1 million house. That's enough real estate for me. I'm going to have some stocks, I'm going to have some retirement, I want some crypto, I want some other stuff. Cool. That's the reason why I talk about all of it, because I'm looking at all of it myself. I want to give you as much information as I can. Someone asked me earlier about oil. Oil almost at $80. And I'm this close to just exiting the oil trade. This close. We'll see. Been in it since 45. Gold got over 1,800. Still comes back. By the way, gold in 2021 up 8%. S&P was up 27. Bitcoin was up 70. And we've had the highest inflation in 40 years. So tell me that gold is a hedge against inflation. We have inflation reported at 6.5%. Gold was up 8% for 2021. It's not a hedge against inflation. It's barely keeping up with it. So I don't know what to tell you about gold, but I wouldn't buy it with your money. And if I found somewhere in a portfolio that I had something that had exposure to gold, I would sell it immediately. That's just me. You do what you want. Let's see here. What else are we looking at? Yeah, you can see the bonds here. The 10-year. It's good if you want to track one, track the 10-year. These charts that I get here, it costs money to have access to these, but you can get access to, the 10-year pretty easily. And it relatively tracks it, relatively tracks what's going on there. I don't pay attention to what's going on in Asia or the EU. I really don't care about that. I'm looking at gold, oil, crypto, and stocks, and ultimately real estate every single day. So, I know it's a very low inventory environment, especially in certain price points. Like if we pull up, let's say just 750,000. And my search criteria here is always 3-bed, 2-bath detached. That's like my main search criteria. Pull up under 750, then you see how sparse it gets. And I am old enough to remember when, if somebody got pre-approved for 600, they wanted to buy a detached house, I knew for sure they were going to find something. And we do not live in those days anymore. So, yes, prices are going up. Yes, that's going to continue. We have no catalyst for inventory whatsoever. I have no catalyst for rates going lower. Right now, we are in price discovery with real estate going up, and we are in price discovery with rates going up. We'll see where we land. All right, guys. That's it for me for now. I'm always here if you need me. Here to answer questions. Here to help out. Specialize in the VA home loan benefit. We do all kinds of loans. We do jumbos. We do conventionals and FHAs too. Specializing in VA. NMLS 155010. Call, text, shoot me an email if you have questions, want some help. That's what I'm here for. And I think I'll have some time on my hands. So give me a shout. Let's see here. What does Dennis have to say? Pretty scary, right, Dennis? Less than 1,400 houses and condos in all of San Diego County for sale, which has got to be a fraction of a month's worth of inventory, right? That's not 1 month. That's like half a month. Half a month's worth of inventory. Meaning if no new houses go up for sale in 2 weeks, we'll have no houses for sale. 0. This is exactly, I predicted this 10 years ago. It's exactly what happened in San Francisco. The same thing's happening here. Exact same thing. Prices in the market up there got so crazy. And it still is. Still is. But at one point, it was so crazy that you had to have all cash. You had to have all cash. There's no way you were getting a finance offer through. No way. Unless you knew somebody. You had to know the seller personally. It was cash deals, 10 days, no contingencies, no appraisals. And you were in a bidding war with a half dozen other people who all had the same ability, the same purchasing power. Will we get there in San Diego one day? Well, let me ask you this. Is San Diego a better place to live than San Francisco? I sure as heck think so. Do we have the same median income? No, we don't. We don't. But I think we will. I'm very, very bullish on San Diego as a city, as a county. I'm very, very bullish on San Diego real estate. I think one day people will look back at this video in 10 years and go, oh my gosh, look at all these properties you could buy for $600,000, $700,000 in San Diego. There will be nothing this cheap. And you could say the same thing about 10 years ago and 10 years before that and 10 years before that. Same thing. Even if you go back to the peak of the crash, the prices will look better than they do now. We're much higher than we were at the peak before the crash. You guys realize that, right? We're much higher in price right now than we were at the very peak before the crash. That scares some people. But all it really tells you, because the crash was totally phony. This is all real. This is 38% of the transactions in San Diego, all cash. This is fully qualified individuals. This is an actual low inventory environment. Prices were going up with big inventory. That made no sense. It was because we expanded the buying pool. We don't have an expanded buying pool now. We have a shrinking buying pool. It doesn't even matter because there's so few homes for sale. Thanks for chiming in, Dennis and Randy and Jed, everybody on here. Appreciate you. Have a great day. I'll be back soon. Take care.